Okay, so we got done with money, banking, fractional reserve banking, how fractional reserve banking works, how the money multiplier works. Now we're going to go into the basic accounting behind how banks create money and what you might see on the test. Okay, so let me open this up here. Now, as you remember from my basic accounting video, and if you don't, you can look a couple back. First of all, we have a T account. Okay, we have a T account because it looks like a T. On the left is always assets. All right. On the right is always liabilities. Okay. An asset is anything you own. A liability is something you owe. You have to pay. All right. Now, for an individual, that's going to be different. Like, for example, an individual, you might have a bank account, like let's say, a $10,000 checking. Forgive my handwriting. Checking account. Okay, for you, that's an asset because you own that money. That's your cash. For a bank, it's different. Now, once we get to a bank, and for you, let's say you own your house. All right, your house will be, let's call it, what did I say in the last one? 300,000 and house. All right. Let's say you still owe on your mortgage. You owe 300,000. You should put 20% down always. So that's 60. So you owe 240,000 on your mortgage. Okay. So the liability to you personally, a mortgage is a liability because you owe that back to the bank. They lent you the money and you owe that. To you personally, your checking account is an asset because you own it. Now, if we go on the bank's balance sheet, it's reverse. Okay, so if you go to a bank, all right, bank, what that would look like for them, try to write this a little bit more neatly. Okay, so we got assets and liabilities, and my $10,000 checking account is a liability to the bank. They call that demand deposits. All right, demand deposit. Why? Because it's available to me upon demand. If I demand my money back, they have to give it to me. So that's a liability because they owe that back to me, right? Meanwhile, they're sitting with the cash to offset that. Now, to them, that $240,000 that, remember, I owe them, if I owe it to them, 240,000, to them, that's an asset, all right? That's a loan. They loaned me the money and they're expecting to get paid that plus interest. So that's what a bank's balance sheet would look like. Now, on the test, there's two main components that they look at. All right. So let's come up with just anything. We'll call it, we go back, it always revolves around reserve requirements. So there's two things that you have to know. Total reserves equals required, let me undo that, equals required reserves plus excess reserves. All right, total reserves equals required reserves plus excess reserves. What do we mean? The banks will have reserves equal to, on the test, as far as they're concerned, equal to their checking accounts or their demand deposits, okay? So that will be broken up into two different categories, required reserves and excess reserves. So their total reserves should match whatever they have in demand deposits. The required reserves is what they're required to keep by law. Excess reserves is what that can become loans. They can legally loan that out. Okay, so that's the first thing You have to know. Now, so if we go back here, let's come up with a hypothetical bank. So there's different assets that you could possibly see on the test. All right, and liabilities. Okay, liabilities. The number one liability that you're going to be looking at is demand deposits. Those are the accounts that they owe back to the people. They might give you one of two things. They might give you total reserves. They might give you required reserves, and they might give you excess reserves. All right, they could break it out, they could not break it out, and they could expect you to figure out any one of those three using that formula I gave you before. Total reserves equals required reserves plus excess. And that's all based upon the amount of demand deposits they have. They could have an account over here, securities. Okay, and those are those government securities that the bank, the Fed buys or sells to them, so that they would get put into that category. It's an asset because they own it and they can earn interest on it. They might have plant and equipment. And the only other liability I see them having possibly is owner's equity. Okay, now the other thing you have to remember on accounting is that it's a balance sheet because both sides mathematically have to balance. If you take from one side, you have to take from the other. If you give to one side, you have to give from the other. Or you could take from one part of that side and give to the other part of the side so it balances out. And you'll see what I'm talking about. So let's come up with a hypothetical here. Let's say it's a 10% reserve requirement. They have to give you that, or they might have you figure it out. Okay, so this is what they could do: assets, liabilities. Let's say we have, to make it easy, again, $100,000 demand deposits. All right, so this bank has $100,000 in demand deposits. What they could say is, all right, figure out what the required reserves are, what the excess reserves are. And what they expect you to do is put down, well, it's $100,000. They have to keep 10%. So if they keep 10%, that's 10,000 in required reserves. And remember that total reserves equals required reserves plus excess reserves. So 100,000 would be their total reserves, all right? 10,000 is their, and that's the liability part of it. 10,000 is their required reserves. So 100 minus 10 means 90,000 of that is excess reserves. Excess reserves normally becomes loans. All right. I've seen them say that. I've seen them say, suppose there's a 10% reserve requirement, but the bank keeps double the required reserves. In that case, this would be the wrong answer. All right. If there's a 10% reserve requirement, but the bank always keeps double what is required, well, then that effectively makes it 20%. So instead of 10,000 required reserves, they keep double that. So they would keep 20,000 required reserves, and therefore out of 100,000, 20,000, they could make out 80,000 in loans. That's one way they could attack that. And again, I'll give you a couple sample problems. And I think in 2009 and 2012, they had examples of this. Or they could put it like this: assets, liabilities. Again, I'll make it 100,000 just so this is easy. 100,000 is their demand deposits, okay? They could give you this. They could say, all right, So they could say, they could give something like that. Um, there's a lot of stuff they could do here. So they could give you that balance sheet and say, if the bank keeps, traditionally zero excess reserves and only keeps its required reserves, what is the reserve requirement for this bank? And you would say, well, out of 100,000, they're keeping 20,000, and you just do the math real quick and say it's a 20% reserve requirement. So that's another thing they could do. Um, they could do something like, I'm trying to think of all the different things they've had in the past. They could do, what was it? They had assets, liabilities, um, making 100,000 demand deposits, and they said 100,000 reserves. Okay, and then they said something like, if there's a 25% reserve requirement, what would the required reserves be? And what would the excess reserves be? And then you would have to break it down um, and say, or you know what, they could do, all right, total reserve, they could do something like this where they have some other account here. Let me make it balance. Instead of 100,000 reserves, they have 50,000 in reserves. So they have 100,000 demand deposit, they have 50,000 in reserves, and I'll make it to match. They have a $50,000 securities. Okay, so they match 100, 100. They could say, if there's a 25% reserve requirement, how many new loans can this bank make? So what you would have to do is do the math over here. 100,000, they have 50,000 in reserves. If it's a 25% reserve requirement, 25 of this, because they only gave you reserves, they didn't give you required reserves or excess reserves. So if they have 50,000 in reserves, I know 25 of those are required. And if you remember that total reserves equals required reserves plus excess reserves, I know this is 50, I know this is 25, so the excess reserves the bank is carrying right now is 25,000, so it can make 25,000 in new loans. Those are the type of questions that they will hit you up with on this test, and it all revolves around demand deposits and required reserves and excess reserves. Another thing they could do, let me think about how they did this here. Let me pause. Stop. All right. I'll take a look at one thing they did because it was a little bit tricky one year. Okay. All right. I looked up, I remembered what this problem was. So here's the balance sheet they gave one year on um, on the test. So they had assets, liabilities, and they had 100,000 in this bank in demand deposits. They had 10,000 in required reserves. They had 5,000 in excess reserves. And they had 85,000 in securities, which is bonds. And then over here they had zero in owner's equity. So because the two sides balanced out, the firm was at zero owner's equity. It didn't have any equity built up. So they asked a couple things. First of all, what would the reserve requirement be here? Now you can pause your thing, take a look at it. I'll wait for you to pause. All right. Now that you're back, 100,000, if the demand deposits are 100,000 and the required reserves is 10,000, it's a 10% reserve requirement. Now, the tricky part that everyone got confused about is suppose Luis or Bill or whatever they said, suppose Bill withdraws $5,000 from his bank account. All right. What would the new assets, liabilities, required reserves, excess reserves look like? Okay. So this is where accounting gets a little bit tricky. So what you would have to do, you know that he withdraws this 5,000 from his bank account. So 5,000, this goes to 95,000, right? Because that goes down because he no longer has that money in his account. But you see the two sides don't balance. You took 5,000 from this side, so you either have to find a way to add it here or take it away from here. So in this case, out of $5,000, you have to figure there's a 10% reserve requirement. So out of $5,000, if there's a 10% reserve requirement, 500 was taken from required reserves, right? 5,000 times 10%. So this would go to 9,500. All right, so the new required reserve. So 500 got taken from required reserves because out of 5,000, 500 of that was required reserves. All right, because their total reserves went down by 5,000. So total reserves equals required reserves plus excess reserves. So 500 of that was required. So 5,000 minus 500. So 4,500 had to come from excess reserves. So in 4,500, 5,000 minus 4,500, excess reserves was left with $500. All right. Now, the bank has to keep required reserves. Here's another thing they could ask. Suppose someone comes in and withdraws, more money than they have in their required reserves. So they draw down the required reserves and they can't make required reserves for the weekend. What can a bank do? Well, that goes back to my banking and money chapter videos. They can either get it from the Fed funds market, they can get a loan from another bank that has excess reserves, or they can go to the discount window and withdraw that money or get a loan from the Fed over the weekend so that they can make required reserves. Banks prefer to go to the Fed funds market. They prefer to go to another bank first. If you look at that, that's been a question on the test before. Why would you want to go to the Fed funds market to a fellow bank rather than the Fed? Well, the way I explain to my students is if you're in a hard situation, would you rather, borrow from your friends or borrow from your parents? All right, I don't know about you. The answer for me was always if my friends can afford it, hey man, you got 500, I'll pay you back. I'm in a pinch. So because if you borrow from your parents, they're going to ask all these questions and what happened? Are you in trouble? And you know what? That's not worth it. Same thing with the Fed. They don't want the excess scrutiny of the Fed breathing down their neck. So if they have to, they will borrow from the Fed, but chances are they're going to borrow from fellow banks in the Fed funds market. Now, here's another thing they could do with this. If we have this left, suppose the Fed comes in and buys 10,000 worth of bonds. All right, what would happen? So let's keep the sheet where it is. So they have 500 in excess reserves, they have 9,500 in required reserves, and they have 95,000 in demand deposits. Sorry for the messiness, but follow them in your head. Suppose the Fed comes in and buys 10,000 worth of bonds. What would this look like? All right. Well, these are the bonds, the securities over here, right here. So this, instead of 85,000, the Fed bought 10,000 of these, so this would go down to 75,000. The two sides don't balance now. What do? Well, if you took 10,000 from here, the conventional wisdom is you have to take it from here. But in this case, that's why they might ask this. So remember I told you when the Fed buys 10,000 worth of bonds, that 10,000 gets added to excess reserves. So this now, instead of 75, they took it from here. This would be 10,500 because it would get, it would get added to excess reserves. So the bank, that can now become loans. So the 10,000 would get taken from here and added to excess reserves, and it would add to the bank's ability to loan. All right. So those are the types of problems that they've had. Remember, all right, so remember, balance sheet has to balance. Balance sheet has to balance. The assets and liabilities have to balance. And total reserves equals required reserves plus excess reserves. If you remember those two formulas, and that required reserves is based off of demand deposits, you're pretty safe. Now, I would go and practice these. If you have the McConnell Brew book, which we do, it's chapter 32. There's some practices at the end of that. If, I told you 2009, 2012, there was a couple problems on the test. So I would go and look at those and get as many practice problems as you could, because there's a good shot it's on this year's exam. All right. That's it. That's how accounting, how banks work. If you major in accounting, that's a little bit more complicated than that, but it's good enough.